Roth IRAs. It can be one of the greatest financial treasures for those saving for retirement, but only if you take full advantage of it. This little understood financial goldmine is largely missed by the masses. In fact, only about 10% of taxpayers understand and use the advantages of this tax savings paradise. What is it that they know that you don't? In this video, we'll break down the Roth IRA. Roth IRAs, one of the greatest financial tax savings assets ever, if used properly. Welcome back to BrightWealth. My name's Scott McLaine. I'm your host, and I'll be your instructor for today's lesson. As always, we're here to accelerate your financial success. In this episode of BrightWealth, I'm going to break down the 5 stages of the IRA, and you can use this information to make more informed and brighter investment decisions. So let's get started with an overview of the Roth IRA. It's an individual retirement account like a traditional IRA that allows for qualified withdrawals on a tax-free basis, provided you follow certain conditions. Established in 1997, it was named after the Delaware Senator William Roth. Roth IRAs are similar to traditional IRAs, except that the major distinction between them is how they are taxed. Roth IRAs are funded with after-tax dollars, and this means that your contributions are not tax deductible. But when you withdraw the money out of your Roth IRA, the distributions come out tax-free. Now, to maximize the benefit and advantages of your Roth, you have to follow the 5 stages of the Roth IRA. Making the decision to open your own Roth IRA can be one of the most important and exciting decisions of your life. If this is your first investment account, I am sure you're excited to begin your journey towards financial freedom. If you're thinking more strategically and are converting existing retirement accounts to Roth for the tax-free growth and income benefits, then you're on a more advanced path, and I'm sure you're excited about the possibilities of your strategy. In either case or anywhere in between, you'll have to get that Roth IRA open as a first step. And so as a reminder, let's quickly take a look at the different types of IRAs to make sure that you get the right one open. The first type is a traditional IRA, and that's the most common. We did a separate video on that, and you can watch that. The one we're talking about today is the Roth IRA, again, named after Senator William Roth. And we're not going to talk about that right now. We're going to be talking about that all day today. The next one is a SEP. We'll be doing a future video on this, and this stands for Simplified Employee Pension, and these type of IRAs can be great for small business owners who have family or friends that are working with them. The contribution limits are much higher, and you can pack a lot of money away into one of these types of IRAs. And the final is a simple IRA, and this stands for Savings Incentive Match Plan for Employees. And a simple is kind of like a 401k for business owners that have less than 100 employees, and allows them to set up sort of a lower cost 401k type option that's technically structured inside of an IRA. And so we'll talk about all of those that simple in a future video. For today, we're going to be focusing in on the Roth IRA, and so stay tuned and we'll give you all the information you need to know. Now, another question is, where do I open up my IRA? And there are really 4 type of main areas to open an IRA. The first and most common is a brokerage account, and that's what we're looking at right here. The most common brokerage would be a TD Ameritrade or a Charles Schwab, or any one of the major institutions. You can also open your Roth IRA at a bank. You can open it at a credit union, or you can open it at a savings and loan. If you're going to open it up at a brokerage account like we recommend, then we recommend you take a look at brightadvisor.com. We work with TD Ameritrade, that the Bright Advisor team does, and they'll open up your Roth IRA for you and help you do all the paperwork and get any rollovers or transfers handled. So that's pretty much stage one, opening up your Roth IRA and getting it started, figuring out where to go. Let's take a look at stage two, funding your IRA, and that becomes a very important next step. For the financially savvy, tax saving strategies drive a lot of our personal finance decisions. Avoiding or lowering taxes can influence where you choose to live, what kind of car you buy, how you structure your business, how you take vacations, how you set up your estate, and so much more. Almost everyone tries to limit the amount of taxes they pay, and taxes play a larger role when we invest for our retirement. One potential way to minimize taxes is to invest in a Roth IRA. Again, with a Roth IRA, you contribute after-tax dollars and withdraw any earnings tax-free in your retirement years. Traditional IRAs work the other way with pre-tax dollars going in, but you're taxed when the money comes out. There are three types of ways to fund your Roth IRA. You can do that through annual contributions. You can do that by rolling over an old 401k or IRA balance that's set up in a Roth structure. And you can also contribute through what's known as a backdoor. And this is great for investors who don't qualify to make money. They make too much money to contribute into their Roth IRA. So let's go ahead and take a look at annual contributions first. And around annual contributions, there are a lot of questions on, when I open up a Roth, how much money do I have to put into it? Do I have to put money in every single month? Can I stop if I don't want to put money into it on a certain month? Questions like that. So let's go ahead and take a look. When it comes to a Roth IRA, as far as a minimum amount of money that you have to put in, the minimum amount that you have to put in on any given year is zero. You just don't have to put money into your Roth if you don't want to. Only if you have the money available after tax dollars. And so you've already paid your tax on it, you have that money sitting around, or you've been budgeting it, and then you contribute it to your Roth IRA either on a monthly basis, or you can do that once a year. Now the maximum that you can put into a Roth IRA is $6,000 per year, at least as of 2021. Now if you're over the age of 50, you can add an additional $1,000 and you can put upwards of $7,000 per year. Now tax day, you have to put that money in by tax day, and tax day for the next year, for 2022, I believe is April 18th on 2022. So as long as you make your $6,000 or your $7,000 contribution into your Roth IRA by the tax day of 2022, that contribution will count for the 2021 year, if you're following me on that. Now, contributions can be all at once, like we talked about, or they can be periodic. So you don't have to put your money in, but you can only put in up to the maximum, otherwise you're going to get penalized. And so if you want to set up a dollar cost averaging system where you're contributing $400 or $500 a month to your Roth IRA, and that just happens month over month over month over month, then that's great. If you want to set it up where right before tax day you pay for the previous year because you've got that extra money, then you can do that. You can also put money in the day after tax day for the next year and have that money sitting there all the way and compounding for you. So you just can't go over the maximum. And again, there's no minimum. Now, if there are two of you, meaning that there is a husband who also has a spouse or a wife who also has a spouse, and your spouse is not working, then you have a second neat little feature that you can do, in that you can make a contribution to a second Roth IRA on behalf of your spouse if they don't have earned income, or if you guys combined don't go over the limits. And so theoretically you could put $12,000 away, or $14,000, or somewhere in between that, depending on the ages of your spouses, and you could get all of that money compounding in a tax-free environment, and then all the gains would come out tax-free following you provide those rules. Now, your IRA and your spouse's IRA, if you contribute to that, are taken from after tax dollars. So what that means is that there's no tax deduction on the given year. In fact, you don't even need to let the IRS notify them that you put money into your Roth IRA. You just need to keep track of that contribution, because there's a thing known as the 5-year rule, and we'll talk about that in a few minutes. But the 5-year rule is going to limit how long you have to leave your money in there before you can take it out. And when you contribute your money will affect that particular rule. Now, this is your contributions. You're making money and you're contributing money into your IRA. You have to have earned income in order to contribute to your IRA. And the money that goes into your IRA is actually pulled from your modified adjusted gross income. And so that's taking your adjusted gross income and factoring out a couple of those other deductions, backing those out. And so you can talk to your CPA on exactly what is modified adjusted gross income. But if you're single and you earn under $125,000, meaning your modified adjusted gross income is under $125,000, then you can make the full contribution to your IRA. If you're single and you earn more, your Maggie is more than $125,000 and under $140,000, then you can make partial contributions. And if you earn more than $148,000, then you can't make contributions based off of earned income. But you could get money into a Roth IRA through the back door, and we'll talk about that in a minute. Now, if you're married, your limits are $198,000. If you earn more than $198,000, your MAGI is more than $198,000. Well, if it's under $198,000, then you can contribute the full amount to your retirement account. If it's over $198,000 and under $208,000, then you get a partial deduction, or you can contribute a partial amount to your Roth IRA, is what I'm saying. And if you earn more than $208,000 as a a married couple filing jointly, if you earn more than $208,000, then you cannot contribute to a Roth IRA through the MAGI method, through your annual contributions. You can get money in through the back door if you want. Now, let's take a look at a rollover. On a rollover, that's the second way to put money in. You can roll over an old 401k, an old 403b, an old 457, and an old retirement savings plan, so long as they are of the Roth variety. And so if you have an old Roth 401k, or you have an old Roth 457, or a Roth 403b, or some other form of a Roth retirement account, then you can roll that money into a Roth IRA, no problem. And there is, you just cannot be employed at that previous employer. So if you're still employed there, unless they have this thing known as a in-service distribution, which is rare, they may have it, you most likely cannot roll over your 401k or your 403b or your 457 Roth to a Roth if you're still working there. You have to no longer be working there. Now, rollovers are not taxable. You're just taking money out of one Roth and passing it to another Roth. So there's no tax consequence on that. Now, there could be a tax consequence if you're going from a Roth, from a traditional 401k to a Roth IRA, and that's a separate thing. We're going to talk about that in a minute. Now, when they do, if you do a rollover, they're going to mail a check to you. So if you do a rollover, you're going to call up your current financial provider where your old 401k is, and you're going to say, I want to do a rollover. What they're going to do is they're going to mail a check to the financial institution where you have your Roth IRA or your IRA already open at. And so they're going to make a check payable to you, payable to that financial institution actually, for benefit of you in the name of your IRA. And so you'll roll over from a 401k Roth to a Roth IRA, or from a 401k, 403b Roth to a Roth IRA, etc. You can go from Roth to Roth, but you can't go from a traditional to a Roth. That's not allowed. All right, now wait, before we go to stage 3, which is investing your Roth IRA, I do want to spend just a little bit more time on the backdoor provision. Many investors / retirement planners do Roth IRA conversions, moving money from their traditional IRA or their traditional 401k into their Roth in order for the tax savings benefits. And this strategy is also known as the backdoor Roth IRA. And basically it allows you that for people that are normally ineligible or have too much money that want to get that money into their Roth IRA in order to do that. And I want to explain how that works. If you're above the income limits, or if you have a 401k, then this is how this works. You've got your money sitting aside over here, in, let's say, this 401k right here, or this IRA right here, and let's say you have 150,000 that you want to roll over for whatever reason that particular year. That's the current balance. And you want to roll that into your Roth IRA. Well, what has to happen is it has to go through the marginal tax system first. And so whether you're married, filing jointly, or you're single, you're going to take the 150, you're going to add it to your income, and up you're going to go on this level. And you're going to figure out where you fall in that marginal tax system, and then you're going to have to pay your taxes for that particular given year. And this is what I wanted to spend just a little bit of time on. Your deadline in order to do your conversion for any given year is on December 31st. And so what that means is that if it's currently the year 2021 and we're sitting here on December 9th right now, and you want to have a conversion for this year, then you have to have that conversion take place and have that money in your account by December 31st of 2021. And if you do that, then your money will count as if it was deposited into your account as of January 1st, 2021, and that will start your 5-year timer. And we're going to talk about the 5-year timer, or the five-year holding period that you have to have your money in your Roth IRA before you can take it back out again. And so if you put your money in by December 31st with a rollover, your timer will start as of January 1st, and then your 5-year timer will start kicking. So that'll be 1 year, 2 years, 3 years, 4 years, and you could actually take that money out as early as January 1st, 2026, assuming you were 59 and a half at that point in time. So essentially that's how a backdoor works. If you make too much money to contribute to your Roth IRA based on your earned income and your modified adjusted gross income, if you're above those limits and you have an old 401k sitting over, then you can backdoor that money into your Roth. Or if you just have an old 401k sitting around and you just want to transfer that money over, regardless of your limits, you can roll that money or use the backdoor to get that into a Roth. And one other key thing to understand on that 5-year timer, you might have multiple transactions, multiple 401ks that are old, or an old IRA and a 401k, and you want to roll those over into your Roth, but you want to do part of it this year and then part of it next year for tax purposes. A big question we get is, do I have a 5-year timer for that first one and the 5-year timer for that second one? And the answer is no. The very first contribution to your Roth IRA, any Roth IRA that's in your name, starts your 5-year timer for all subsequent rollovers or transfers ever in the future. So once you get that 5-year kicker going, you've met the provision, and you can transfer or backdoor more money later and still access that money as long as you're 59 and a half. And again, if you have questions on this, you can always schedule an appointment with the Bright Advisor team, and they will answer your one-on-one specific questions, even re-answer questions that we've answered on this video. So that's the backdoor. We'll do a whole video on this later. Be sure to subscribe to our channel. But let's go ahead and take a look at stage number 3, investing your Roth IRA. If you've done your job right, you've opened up your Roth IRA and you've put money into it. And so now it's time to invest those funds. And depending on your own personal life situation, you'll have different goals for this asset. Some people, their goal is going to be retirement income. And if that's the case, maybe you're going to be looking at balanced growth or target date funds or ETFs, etc. Some people are going to be focusing on growth and income. And really what you're looking for is that income and the growth of those companies. So you're going to be buying dividend paying stocks or growth type funds. And others are focused or using their Roth IRAs for speculation. And so they'll be using this particular asset for buying and selling stocks on a frequent basis. And so as a side note, Roths are great for speculating or day trading or buying and selling companies in the short term because of the tax benefits of this particular asset. Once you have money in there, when you're buying and selling companies, there are no short-term capital gains, also known as ordinary income, to report at the end of the year. This means if you buy a stock for 50 cents on a share and you sell it at $1 a share and take your profit in a given year, you don't have to pay tax on that, ever. You don't have to pay tax on it this year, and you don't have to pay tax on it when you take it out. That's one of the most amazing things about a Roth IRA. It almost feels illegal that you can buy and sell stocks and not have to pay any tax on it, ever. as long as you follow the rules of the 5-year rule. That's one of the reasons that Roth IRAs are so exciting for so many people. So depending on your goals, there's a lot of things you're going to have to consider based on those goals, which assets you're going to buy. And so let's take a look at some of the common asset classes, the market sectors, and the different types of market capitalization that you might be buying. Now, most people, when they're inside of their Roth IRA, are going to be buying stocks, and that's what we have right there on the first list. You might also pick up bonds, with this particular asset, or have them bonds inside of ETFs that you would buy, that is a collection of stocks and bonds, or a mutual fund. And so these are the most common asset classes that you will use inside of your Roth IRA: stocks, bonds, ETFs, mutual funds, and then you'll hold cash from time to time in order to then make your purchases. Now, this is if you're managing your own account. If you have someone else or a professional financial advisor managing your Roth IRA, they might have a different strategy for you. Now, you're going to choose asset classes, the stocks, the bonds, ETFs, but you're going to have to choose them out of different market sectors. And so the market sector, another way of looking at all the collection of stocks, might be energy. And there's a whole sector called energy. And you can buy within that sector. You might find that at certain times, because of the political climate or because of what's going on in the world, that certain sectors are going to outperform others. And the energy sector has been on a rebound. Materials, physical materials, and so those companies might see a rise in profits because of the cost of inflation, the cost of goods becoming more and more expensive, or you might find a decrease in these companies because of that, depending on their model. And so just understanding what's going on in the political and in the world and the climate, understanding what asset classes you're looking to buy, and then figuring out what sectors you want to be in is all part of your decision when you're getting ready to invest your fund. Finance is another big sector, and there's a lot of advances happening on the finance sector. And now, when you're looking at these different market sectors, industrials, utilities, healthcare, consumer staples, consumer discretionary, you also have information technology, real estate type of stocks. All of these different type of sectors that you can put your money into are going to be inside of companies or inside of funds, but typically inside of companies that have a different market cap. And the bigger that market cap, usually the more conservative that company is going to be. Think of an Amazon or an Apple or a Microsoft or a Google, some of these major corporations. What is the likelihood that they're going to go out of business tomorrow for some reason? And it's rare that happens. It does happen, but it's rare. And those are going to be your mega cap stocks. Companies are going to start on the micro cap from 500 million to 300 million. And then they're going to be classified from 300 million to 200 million as small cap. Mid cap is going to be 2 billion to 10 billion. Your large cap is going to be 10 billion to 200 billion. And your mega cap is going to be 200 billion plus, meaning the company is larger than 200 billion. That is investing your Roth IRA. Again, you're going to choose your asset class. You're going to choose which market sector that you want to be in or sectors that you want to be in, and then also the capitalization. Smaller cap companies are going to be more volatile typically and have higher potential returns in some cases, but also the potential risk of losing your money. And the bigger companies, you just got to watch and do your research on them. You can kind of follow their historic growth rates and kind of estimate where your performance would end up if you invest in those companies based on historic performance of those companies. So that's investing your Roth IRA. Again, if you have questions, you can always meet with the Bright Advisor team. They're happy to work with you and help you understand what stock picks or what type of allocation you should put together for your portfolio or for your Roth IRA. All right, let's go ahead and take a look at the next stage, which is stage number 4. This is my favorite one. It's all about growing the funds in that Roth IRA. Your IRA takes attention, and growing it is something that you're going to have to do over the course of your lifetime. It's not something that's going to happen on its own. You are literally going to have to watch and grow your investments year over year over year. And the question is, are you the type of person that wants to do this on your own, Or do you want to have a professional who manages investments for a living manage your Roth IRA for you? Well, let's go ahead and take a look at the person, some of the character traits of people that love to do this on your own. And you know, if that's you love the excitement of researching the stocks and figuring out which ones you want to buy and taking that money and buying it and then watching that price go up and go down and then ultimately picking that right time to sell and take your profits. And again, one of the best things about a Roth IRA is that if you are buying and selling stocks and you're making profits, you buy something at 50 cents and you buy 100 shares or 1,000 shares of it and it goes up to $1 and you double your money on it, you don't have to pay those gains that year for taxes, and you don't have to pay those gains ever, as a matter of fact, inside of your Roth IRA, as long as you follow the rules. So for those that love to actively manage or day trade or grow their IRAs actively, Roths are an awesome opportunity because you're never paying the gains either now or when you take the money out. So if you are the type of person who's going to be managing your own account, and again, this isn't the comprehensive list, here are some tips that'll help you self-manage your own account. The first one is to know your tolerance for risk. And what I mean by that is if you invest $5,000 into your Roth IRA and you buy a stock at 50 cents a share and it goes down to 25 cents a share, how does that make you feel? Your 5,000 just turned into 2,500. Does that freak you out, or are you okay with that because you really believe that little stock that went down to 25 cents is going to go back up to 75 or $1 in the short term? And so if you're okay with those big swings of your account value, then your tolerance for risk is low. If this is all the money you have in the world and it's not like just a speculative bucket, it's not like you have a 401k over here with 100,000 in it and you're 25 years old and you're just betting 6,000 on this Roth IRA and speculating with it. If this Roth IRA is all you have and it's your first account or it's your only money, then maybe your tolerance for risk is less. And you can figure out your tolerance for risk with these online questionnaires, or you can call Bright Advisor or schedule an appointment with them. They can work with you to understand your tolerance for risk and what type of investments you should be in. Or if you already have an advisor, you could reach out to your current advisor and say, hey, I'd like to do a risk tolerance questionnaire. And they'll run you through whatever system they're using, and it's standardized questions. And as a result of that, you'll get a number, and that will tell you what type of tolerance you have and what type of investments you should be in. Okay, so that's tolerance for risk. Number 2 is to know your time horizon. If we're looking on our timeline of our life right here, and we're following along here, you can see along that we've got the years of our life here and then our wealth accumulating here. So as we go along our life, our wealth hopefully accumulates, and then we take income from it. Now, your time horizon starts where your current age is. So if you're in your 20s, it starts right there, and it ends technically where you're going to be checking out. So if this was 120 years old, maybe you were really healthy and you lived a long time, that whole period from when you are right now to when you pass away is your time horizon. And so the first part of that time horizon, this part right here between where you are, this is your accumulation years. These are the years where you're going to accumulate and gather as much money as you can. And then between your accumulation years and the time you pass, these are your income years. You're going to take income along these years. And so that's your total time horizon, your accumulation years and how many years you're going to live in income. And you need to make sure that your money is going to last you all the way along the way, your entire time horizon. And so, again, part of what to be paying attention to. Number 3 is to know your investment goals. Choose your investment goals. And before you start your Roth IRA and in growing your Roth IRA, you need to understand your goals. Are you a retirement planner? And are you planning for your retirement? Is that your goal? Are you using this for growth and you're looking to get income out of it at some point in the near future? Or are you using this for speculation and you want to buy and sell companies and swing for the big profits and you're just going to keep putting $6,000 every year in this Roth IRA, maxing it out and buying and selling companies? And that's what some people do with these type of accounts. Whatever is right for you is right for you. I'm not saying what you should or shouldn't be doing, but a Roth IRA has certain advantages to it that lead to certain types of investors because of the no gains taxes that you have to pay on this year's gains. And when you take your money out, there's no gains. Okay, number 4 is you're going to need to research and then you need to buy your equities. And so you need to do the research on the companies and track them and monitor them and understand their historic performance and look at the levels of when the stocks are going up or going down if you're going to be buying your own stocks. If you're buying for the long term for retirement planning, then pick your ETFs or your mutual funds or the individual stocks that you're going to buy for the long haul because you think that they have a long-term profit in them. That's what Warren Buffett did. That was his style, was to pick companies for the long term. And you can see his book, well, you can't see it in that particular, right there, Charlie Munger. That's Warren Buffett's other half. And those two guys built mass fortunes by buying companies for the long haul. Not so much concerned about the up and down of the stock. You're buying the company because you believe it has long-term potential. And so, again, some of the tips. Finally, you want to review and revise your strategy on an ongoing basis. And so those are some of the tips for managing your own account. And you may or may not be the type of person who wants to manage their own account. Speaking of Warren Buffett, one other tip that he left that he gives to young finance students or young individuals planning to grow their own retirement account, he says that, you know, if he had it to do over again, he would give you a punch card. And on that punch card, you have 20 abilities to punch holes. And each hole is one purchase of one company with your money. And you only get 20 punches your whole life. He said that's more than enough to build mass fortunes of wealth when it comes to growing your account. You don't need to have hundreds of great picks. You just need to wait and wait and wait and wait and do your research and find the right company that's right for you. And when you find the one that makes sense, that feels right, that you feel it inside, you know because you've done your own research that this particular company and its own business model is going to work, and then you can buy that company and you hold it. And you hold these companies for 5-10 years, and if you can get an average growth out of those companies of more than 7 or 10% a year, you're doing great. And so that leads me to the next point, that either you're the type of person that loves to do this on your own, or you're going to have an advisor do it for you. In either case, you have to measure your performance one way or the other. And on this one, you're going to measure your performance by tracking yourself against a benchmark. And when I say a benchmark, what I mean by that is if you took your current investment strategy, you started at $0 here, let's say at age 20, you contributed $6,000 a year every single year until you were 65, and you grew your account at an average of 7%, what would it turn into? Excuse me, and your advisor can run that for you, or there's online websites that can run that for you. But in any case, a benchmark that would track that performance, you invest that money, $6,000 a year, ongoing into the S&P 500, and you can see how would it have turned out, or how will it likely turn out going forward if I track my investments against the S&P 500. The S&P 500, since its inception back like in 98 years ago, or 92 years ago or so, it goes way back, it has about a 10%, between a 10 and 11% average rate of return, way back when. If you look at the S&P 500 over the last 40 years, you have maybe a 7 or an 8% rate of return, somewhere around there. If you look at it over the last 15 years, a little slice of time, the S&P 500 might be closer to 9 or 10%. In any case, the S&P 500 is a very easy ETF to buy, or a very easy mutual fund to buy on any platform, any brokerage account that you're on. You can log online and just type S&P 500 and find your pick. And you can buy a mutual fund or a ETF that mirrors the S&P 500, or some combination of the S&P 500 and the Dow Jones and or the NASDAQ, or whatever you want to use for your benchmark. But you can buy the S&P 500 with your money and just leave it alone, and it will go up and down as the S&P 500 did, which again is a collection of 500 of the biggest companies in the stock market. And so if you can buy the S&P or the Dow Jones and you can earn, let's say, 9% on your money on average over the course of your life, then if that's what historically the S&P has been doing on its own, then either if you are tinkering with your own retirement account, you're buying and selling companies, or you have an advisor buying and selling companies for you, you should be able to outpace the S&P 500. You should be able to do better than that. If you're doing worse than that, if you're underperforming by tinkering, then you should stop doing that, and you should just put your money in something that's going to just grow on its own. But if you can outpace it, then great, you got something going. If you're underpacing it, then figure out what you're doing and either just put the money in the total market, in a S&P 500 or some sort of total market fund and or target date fund, and let it set. Now, you might want to have a professional financial advisor manage your account for you. They do this for a living. Now, there's two types of financial advisors, just so you know. There's the kind that create passive portfolios and the kind that create active management, where they're trading your account on a regular basis. Most financial advisors are passive. They're going to create an allocation and they're going to put it out in the stock market for you. Now, each year you're going to sit down with your financial advisor and they will take a look at the performance of your portfolio. Have them benchmark their performance against the S&P 500. If they're underperforming the S&P 500, then what are they doing? If they're outperforming the S&P 500, then they've got something going. You're doing a great job. Now, a financial advisor is going to cost somewhere between 1% and 2% per year for them to manage your funds. So they shouldn't just be mirroring the benchmark. They should be outperforming the benchmark by at least what they're charging you. Otherwise, you don't even need them. You could just put your money in the benchmark on your own. You need to make sure you're outperforming the benchmark. That's the key. And so you got to figure out what that's going to be, whether that's going to be the S&P 500 or the Dow Jones or whatever you're going to use for that. And your financial advisor should also be securities licensed. So you're going to want to make sure that they have a 65 license, a 7 license, maybe even a certified financial planner, which isn't necessarily a license, but it's a designation. The Bright Advisor team, by the way, has Series 65 investment advisory licenses. They have Series 7 stock brokerage licenses. They also have the certified financial planner designation on staff, and as well as other designations as well. So you're fully covered. If you have questions about your finances, you can talk and schedule an appointment with the Bright Advisor team. They're happy to meet with you. By the way, the Bright Advisor team, on the difference between active management and passive management, is an active managed portfolio. And what that means is those advisors are trading your stock account, your Roth account, your brokerage account, your IRA account every single month based on your risk tolerance that they predetermine with you. And they're actively seeking better gains than the benchmark. And so if they can outperform the benchmark historically and show that to you, then it's possible that they can do that going forward. And so it's always good to take a look at either your current advisor or the Bright Advisor team and have them take a second guess at what you're doing, or have them take a look at your Roth and have someone manage it for you professionally. So really quick, that's pretty much growing your Roth IRA, either doing it on your own or having a professional team doing it for you. And when it comes to your Roth, the whole idea of growing it is so that you can grow it to an ultimate amount of money that you can start taking income out of. And there are certain rules around when you can take money out of your IRA. You have to leave it there for a certain period of time. But if you follow those rules, then all that income coming out is tax-free. So let's move on to stage 5, taking income from your Roth IRA. Stage 5 is all about the income. It's an important stage because there are penalties if you do it wrong. So be sure to pay attention here. Now, your Roth IRA is a bucket of money that has grown tax deferred. Now, that money will come out tax-free as long as you follow the rules. So there will be no taxes that you have to pay on that Roth IRA. But you have to wait at least 5 years in order to take that money from your Roth IRA, and you have to be 59 and a half years old, meaning that you can put money into your Roth IRA, and then that money that goes in, whether it came through a transfer or through a conversion or the backdoor, or it came through a distribution, you put money in, a contribution, you have to wait 5 years. And there's some rules about that. We'll talk about that in a minute, how to count that 5 years. But you do have to wait 5 years, and you have to be 59 and a half to take the gains out. Now, you can put money into your Roth IRA and take the money that you put in out at any time. There's no rules around that. So if you contribute $30,000 to your Roth IRA over the first 3 years, and then in year 3.5 or 4, you want to take 10 of that back out again, there's no restrictions on the money that you put into the Roth, just the gains that your money has accumulated. So just keep that in mind. 5 years, 59.5. Distributions are tax-free, so long as you follow the rules. And if you don't follow the rules, then there will be a 10% penalty, plus you'll have to pay taxes for taking that money out early. So what I want to do is just briefly go over the 5-year rule, because that's really the main component to a Roth IRA. So let's take a look at the first 5-year rules that deals with withdrawals off of contributions, meaning that you put money into your Roth IRA more than 5 years ago, and you did that through contributions, through annual contributions. It wasn't part of a rollover. And so that's the first one. We're looking at withdrawals that came from contributions into your Roth IRA. Now, you have to be, first off, on or over the age of 59.5, like we mentioned earlier. That's the first restriction that you have to have. Secondly, at least 5 tax years have passed since you made that first contribution to your Roth IRA. Now, keep in mind, that's your first contribution to a Roth IRA, not the one that was made like 5 years ago exactly. So if you opened up a Roth in your 20s and you made your first contribution to it, and then you never contributed again until you were 35, and then you made a big contribution into your Roth IRA when you were 35, your 5-year period has already passed. So as long as that money goes into the Roth, it can come back out tax-free plus gains, as long as the second rule is met, that you're 59.5. So hope you got that straight. As long as you're 59.5 and the money's been there 5 years, you're good to go. So here's how you count the 5 years. And by the way, you can withdraw your contributions made to your Roth IRA tax-free at any time and penalty-free. That meaning your contributions that you made, not the gains. And so you don't have to wait 5 years for your contributions just to take the gains out of your Roth IRA without penalty. So if the year was 2021, and that's the current year, and let's say you made contributions to your Roth IRA this year, how does that 5-year timer work? That's what we're going to take a look at right now. So this year, as of 2021, your tax deadline date is going to be April 18th of 2022. And so as long as you make your contribution to your Roth IRA by that date, April 18th, if that's the date, of 2022 right there, as long as you make your $6,000 or $7,000 contribution to your Roth IRA by April 18th of 2022, that contribution will count as if it went in on January 1st, 2021. And your 5-year timer, your first 5-year timer, if that was your first contribution, will start counting as of January 2021. So that to January 2022 will be year 1, this will be year 2, this will be year 3, this will be year 4, that will be year 5. And even if you make your contribution on April 18th of 2022, you could take that money out as early as January 26th, January 1st of 2026, assuming you were 59.5 by that age. And so that would really only be like 3.5 years away because of the way that the IRA is credited, the Roth IRA is credited with your money from that contribution. So that is dealing with withdrawals from your Roth IRA when you made annual contributions, and the tax year for the annual contribution starts on the January 1st of the year of your tax year. So if taxes are due January 15th or April 15th or April 18th, whatever that date is, then go all the way back to January 1st of the previous year, and that's when your contribution 5-year rule will start from. Got it. Hope you guys got that. If you don't, schedule an appointment again with Bright Advisor. I know I repeat that, but it's why we have that team available to meet with you to answer all these questions to help you understand your scenario. The second 5-year rule that we're looking at is if you did a conversion, if you put money into your Roth IRA via the back door, how does that 5-year rule count? And so again, you have to be over the age of 59 and a half, and your money has to have been in there for 5 years. It's the same thing. You take money out of your IRA. At the time you made your contribution, you went through the marginal tax system, and then what was left over was contributed to your Roth IRA. So you paid your taxes way back when you made that transfer. And so that transfer, those taxes that you made on that transfer, the question is, when is this money now available to you? And so let's say you made your rollover, you did this backdoor contribution into your IRA as of December 31st. That's your cutoff date. So by December 31st of December 31st, 2021, your contribution, your backdoor contribution will count as of January 1st, 2021. So if you make it by December 31st of that year, then your 5-year rule will start as of January 1st. Unlike a normal contribution to your IRA, if you make a backdoor contribution after the 1st, sometime between the 1st and let's say tax day, that is going to count for the next year. So you don't get to go all the way back to January 1st of the previous year if it's a rollover. If you're doing a rollover or a conversion into the backdoor, then that contribution has to be made by December 31st of the current year, and that will be credited, and your 5-year timer will start of January 1st of that year. So hope that makes sense. Those are the major distinctions to understand when it comes to the 5-year rule. And again, direct message us, put questions in the comments, or schedule an appointment with our Bright Advisor team if that doesn't make sense, or you still have questions about that, or you want to talk about your own individual scenario. Guys, that's the 5 stages of a Roth IRA, one of the most profound financial treasures that are available to you. The tax saving strategies, the tax savings growth, and the money that comes out tax-free is just an incredible opportunity for you. I hope you found value in this video. Be sure to like and subscribe our YouTube channel and hit that bell for subscription notices. If you have questions, leave them in the comments, and there's a description in there where you can schedule an appointment with the Bright Advisor team if you have one-on-one questions. My name is Scott McLaine. It's not what you make, it's what you do with what you make. I look forward to seeing you on future videos. Until then, peace out.